In today's video, I will discuss 6 things I learned from The Intelligent Investor. Be sure to watch to the end to learn how you can invest more intelligently. Welcome to I Will Become a Millionaire, the YouTube channel that is part financial journey and part education. The first thing I learned from this book is the difference between value investing and speculation. A stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its share price. Value investing is an investment strategy that involves picking stocks that seem to be trading for less than their book value. And speculation is guessing this value without firm evidence. People who speculate buy stocks as if they were playing a video game, rather than looking at the actual value of the business. Speculating seems so complicated because it doesn't make any sense. Why would you choose to use your gut instinct or look at dots on a line to make a decision with little to no evidence when there is actually a lot of useful information around? You should be relying on hope as little as possible, as speculating is gambling and your luck will run out. In periods of incredible luck, like from March 2020 to now, people should be careful not to think of themselves as some kind of savant and base their future investing strategies on events that almost everyone has done well in. You should determine the actual value of a business before buying it, in a similar way that you would with a house. You must thoroughly analyse a company and the soundness of its underlying businesses before you buy its stock. You must deliberately protect yourself against serious losses. You must aspire to adequate, not extraordinary performance. Margin of safety. To distill the secret of sound investment into 3 words, we venture the motto, margin of safety. No matter how careful you are, the one risk you can never eliminate is the risk of being wrong. Your risk level can be massively reduced by insisting on what Graham called the margin of safety. This means never overpaying, no matter how exciting an investment seems to be. Warren Buffett has declared the margin of safety to be one of his cornerstones of investing, and has even been known to apply as much as a 50% discount to the intrinsic value of a stock as his price target. In this case, it means an investment could be both low risk and high return. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Ignore Mr. Market. The stock investor is neither right or wrong because others agreed or disagreed with him. He is right because his facts and analysis are right. Mr. Market was created by Graham as a fictitious personification of the market. He is a manic depressive, meaning he is constantly swinging from optimism to pessimism, with his investing strategy being a response to his mood, rather than as a result of fundamental analysis. He tells you what your ownership in a business is worth, which is like a man coming to your house and telling you how to feel. For example, if the company you have shares in is performing better, but the share price is lower, what should you do? Well, Mr. Market would tell you to sell. There may be a reason for this, or there may be no reason at all. A bit of bad press, for example, may decrease the value of a share by 25%, while its profits continue to grow. I have been buying stocks based on the noise from Mr. Market, and despite my success over the past few months, with unrealized gains of around 30%, based on this book, I am going to sell a lot of my portfolio and make more intelligent decisions to create a new, more sustainable portfolio. Keeping your emotions in check, especially in the presence of Mr. Market, can at times be as useful as financial literacy. But investing isn't about beating others at their game. It's about controlling yourself at your own game. Beware bubbles. A bubble is a place separate from reality that is characterized by the rapid rise of market value. This is followed by a quick decrease in value, referred to as a crash or a bubble burst. In a bubble, investors will buy an asset not for its fundamental value, but because they plan to resell this asset at a higher price to the next investor. You should not succumb to the perceived certainty that any industry will outperform all others in the future, abandoning all the previous rules of investing in the process, such as the fact that massive growth is unsustainable due to the limits of the size of the market. In addition, If a company is highly speculative and you don't understand the business, you won't be able to predict if they will do well or not. Beware of fads and look at the graveyard of failed ideas of the past. Also, just because you make high returns, it does not mean that you are acting intelligently. To see why temporarily high returns don't prove anything, imagine that two places are 130 miles apart. If I observe the 65 miles per hour speed limit, I can drive that distance in 2 hours. But if I drive 130 miles per hour, I can get there in 1 hour. If I try this and survive, am I right? Should you be tempted to try it too, because you hear me bragging that it worked? Flashy gimmicks for beating the market are much the same. In short streaks, so long as your luck holds out, they work. Over time, they'll get you killed. When to buy and sell? The intelligent investor is a realist who sells to optimists and buys from pessimists. Many investors buy when the share price is high and sell when the price is low. However, stocks become riskier as their prices rise and less risky as their prices fall. The intelligent investor dislikes a bull market as stocks become more expensive to buy and wishes for a bear market since it puts stocks back on sale. There are many ways to determine how expensive a stock's price is. Value investors turn to financial ratios to help analyze a company's fundamentals, such as a price to earnings ratio. This ratio measures a company's share price relative to its earnings per share. You can often find this pre-calculated on websites like Google. A high PE ratio could mean that a stock's price is high relative to earnings and possibly overvalued, or a low PE ratio might indicate that a current stock price is cheap relative to earnings. The higher the PE ratio, the more expensive the stock. A rule of thumb is to try not to buy a stock with a ratio over 25, with a lower number being better. So, for example, Tesla is very overpriced with a PE ratio of over 1500. This is just one way to value a stock. There are many other quantitative factors you could consider, such as other ratios, cash flow, profitability, and the increase in share price, as well as qualitative ones. Comment below if you'd be interested in me making a video on some other ways to analyse a company. The market overreacts to good and bad news, resulting in stock price movements that do not correspond to a company's long-term fundamentals. The overreaction offers an opportunity to profit by buying stocks at discounted prices. Hold a diversified long-term portfolio. Don't let fear and greed change your investing criteria and values. Long-term investing protects against the risk of panic selling stocks as a result of the influence of Mr. Market. As long as the company's management is good, you should hold on to your shares as you will have ever-growing dividends. Remember that consistent, moderate growth leads to exponential growth as a result of compounding. The reason your portfolio should be diversified is that there is always the chance that you could be wrong. If this is true, does it make sense to invest a large percentage of your money, such as 25%, in only one stock? However, it is worth noting that margin of safety goes hand in hand with diversification. It is worth considering that many fund managers don't beat the market, especially once their fees are taken into consideration. If you're not willing to put in the work to find the intrinsic value of companies before buying them, you could consider investing a fixed amount each month into well-diversified index funds with good track records, such as funds that mirror the S&P 500 or FTSE 250. In summary, know the difference between value investing and speculation. A margin of safety can massively lower risk. Do not let Mr. Market influence your decision making. Beware bubbles as they can cause you to be speculative. Sell to optimists and buy from pessimists. Hold a diversified long-term portfolio. Please like and subscribe if you enjoyed this video. If you want to buy a copy of this book or get a free share from Trading212, please see the links in the description. Please let me know your opinions, questions and suggestions. Thanks for watching.